There are two types of analysis used in financial statements, and they are vertical and horizontal analysis method. Firstly, for vertical analysis is a method that compares data within the same reporting period. When using vertical analysis, a line item is listed as a percentage of a base figure within the statement. For example, line item on a P&L statement can be stated as a percentage of the gross sales. Line item on a balance sheet itself can be stated as a percentage of the total asset or liability. Finally, cash inflow or outflow on a cash flow statement can be stated as a percentage of the total cash inflow. The vertical analysis make it much easier to compare the financial statement of one company with another company and also across industry. This is because one can actually see the relative proportion of a account's balance. It also makes it easier to compare previous period of time series analysis. Quarterly and annual figures are compared over a number of years to gain a picture of whether the performance metrics are improving or deteriorating. On the other hand, we have horizontal analysis, which compare data across multiple reporting periods. Horizontal analysis can use either absolute comparison or percentage comparison, where the number in each succeeding period are expressed as a percentage of the amount in the baseline year, with the baseline amount being listed as 100%. Any data can perform horizontal analysis as long as there is the minimum of 2 years worth of data. However, 5 years worth of data is usually recommended for a most accurate trend analysis. For instance, you can compare the account receivable in 2014 against the account receivable in 2015. Horizontal analysis will allow investors and analysts to actually see what has been driving a company's financial performance over several years and allow them to spot trends and growth patterns. In addition, this type of analysis enables analysts to actually assess relatively change in different line items over time and project them in the future. The primary difference between vertical analysis and horizontal analysis is that vertical analysis is focused on the relationship between the numbers in a single reporting period or one moment in time. On the other hand, the horizontal analysis look at the amount of financial statement over many years. Every tool has its disadvantage and advantages. For example, using the vertical analysis will only require financial statement for a single reporting period. It is very useful for inter-firm or inter-departmental comparison of performance, as one can see the relative proportion of the account balance no matter the size of the business or the department. However, the vertical analysis may cause the company to lose out on comparison across different time periods to gauge the performance. The best way to go about this is to use the vertical analysis in conjunction with the horizontal analysis rather than just either or. Using the horizontal analysis will allow the company to review its performance across previous periods and gauge its performance based on the past result. However, it has its disadvantages too, include the fact that the aggregated information expressed in the financial statement may have changed over time and will cause variance to creep up when account balance are compared across periods. Secondly, horizontal analysis can also be easily manipulated to show comparison across periods that will make the result appear as good or excellent for the company. Thus, this will actually have a misrepresenting the results. For instance, if the profit for this month are only comparable with that of last month, they may appear outstanding that they may have been the case compared with the previous year. To avoid such a very manipulated interpretation, the company should use consistent comparison period. In the following video, we will look at some of the errors that may occur when processing the data collected. See you there.